Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Life doesn't come with instructions. It comes with updates, bugs, and a support desk that never replies. We call it going with the flow because admitting we have no plan sounds irresponsible. We're cautiously optimistic, meaning we hope for the best and have already prepared excuses. Liquidity is confidence with a shorter memory. Political debates are where facts go to get interrupted.
A $200 billion bond buying splash is being pitched as instant relief for home buyers. Markets hear something else. Politics edging from rate pressure into outright asset purchases. That line, once called, people's QE, is back in fashion. Yes, buying MBS can nudge mortgage rates lower, but can also inflate house prices, shifting pains from EMIs to entry barriers. Bottom line, affordability isn't just a rates problem, it's a supply and prices problem. When politicians trade bonds for votes, markets eventually demand a higher risk premium. This US jobs report managed to please everyone and move almost no one. Payrolls missed a bit, but unemployment dipped to 4.4%, wages stayed firm at 0.3% month on month, and participation behaved. For markets, that's a shrug, not a shock. For the Fed, it screams no rush. With growth steady and pace still sticky, Powell gets to wait, and definitely not cut in January. Now all eyes shift to inflation because that's the data that actually changes the direction. The AI investment boom feels massive until you size it properly. At about 1% of US GDP is a roughly shale boom scale and only half the punch of the 1990s dot-com surge. Translation: transformational for certain companies, less so for the whole economy, at least for now. History says the real booms show up in capex and productivity. AI's first act is earnings excitement. The macro payoff needs time, diffusion, and fewer PowerPoint slides per GPU. As Robert Solow once said, you can see the computer age everywhere, but in the productivity statistics. The dollar did not just lose religion in global reserves, it lost valuation. Strip out exchange rate moves, and the dollar's reserve share is basically steady. The headline decline? Mostly accounting, not central banks staging a quiet rebellion. When the dollar moves, reserve shares move with it. No selling required. Translation: this is FX arithmetic wearing a geopolitical costume. Reserve managers still like liquidity, depth, and safety, and the dollar still checks those boxes. This chart is not subtle. The US has nearly 1,400 companies above $5 billion in market capitalization, more than China, Japan, and India combined. That's not just scale, it's depth, capital markets, risk appetite, and exit options all working together. India's 215 is progress, but it also shows the next bottleneck. Breadth remains valuation. Global money doesn't just chase growth, it chases liquidity. And on that score, America is still the default setting. Iran's oil footprint is often underestimated. Count not just crude, but condensates and natural gas liquids, and output is pushing 5 million barrels a day, a 46-year high. Even under sanctions, those barrels matter. For oil markets, this is a quiet ceiling on prices and a wild card in any geopolitical scare. Ignore Iran in your supply math and you will overpay for every headline. As Daniel Yergin said, the oil market is never just about oil. Gold surge isn't de-dollarisation, it's re-goldization. Central banks aren't dumping dollars, they're adding insurance. Sanctions risk, geopolitics, and balance sheet credibility have made gold the reserve asset that with no counterparty risk and no press conference. With the gold market small and central banks demand steady, even modest reallocations move prices fast. The dollar remains dominant, but gold is back in the vault, quietly reclaiming relevance. As JP Morgan said, gold is money, everything else is credit. Buying stocks at lofty valuations doesn't make you long-term, it makes you patient. History shows that when you overpay, equities deliver bond-like returns with equity-level heartburn. Low starting valuations are where compounding actually works. High ones just test your faith. Time heals many things but doesn't forgive price. Entry matters, especially when optimism is fully priced in. As Howard Marks said, you cannot predict, but you can definitely prepare.